Just how damaging has this three-day sell-off been? Well, for some of Wall Street's most loved stocks, it's been pretty painful. Take a look at some of these market cap losses. Apple, Microsoft, Amazon, and Alphabet all seeing declines of more than $100 billion. Tesla and Facebook down by more than $70 billion in market cap each. Is there still a lot more to go? Or as Jim Cramer quipped earlier, does the third down day clean out the sellers? Gina Sanchez is CEO of Chantico Global, and Michael Schumacher is head of macro strategy for Wells Fargo Securities. Good to have you both here. Gina, this is a different kind of sell-off today that makes it interesting. We have energy underperforming. We have, Tesla's down there. We have wind resorts at one point didn't look so great. It has kind of a China feel to it, whereas the growthy names haven't been hit as bad as they were last week. What does that tell you?
Well, I think there's a few things going on here. We had obviously very stretched valuations where I think a lot of investors were pricing into infinity this shift in remote working, remote learning, et cetera. And they priced it accordingly. And so some of that was always going to be kind of vulnerable to any kind of a pullback. But what you see in the energy sector is telling us that we're sort of doubting the recovery, that we're going to have a strong kind of surge in demand as the recovery trade. And that's also going to hit some other consumer names as well. And so that recovery trade, it may not be the kind of recovery that we've priced in. We've priced in a really, really aggressive recovery. It's probably going to be a very slow and drawn out recovery. That's just not what's in the markets right now. So the markets have to reprice.
All right. Well, this is going to be a pretty somber conversation then, because Michael Schumacher, I know you're a little bit on the bearish side as well, or maybe bullish, we'd say, in the Treasury market. So you think the yield on the well, no, I'm misreading this. I'm sorry. You do mean that you think yields are rising. I forget how low we've come. So 1% on the 10-year, maybe that's a brighter outlook than I thought.
It is. It's not too bad, Kelly, frankly. And I think it's good to take a bit of a look back and remember that the S&P is still up almost 50% from its low. That's remarkable. So that's from March. Now, since that time, Treasury yields have fallen. So for us to say that yields go up 30, 40 basis points, 35 maybe by year end is not really a crazy call.
Right.
We think the markets have gotten ahead of the economy, frankly.
But so expand on that for a second and what Gina was just saying. What do you sense that the markets are sort of largely speaking reconsidering whether the V that we've seen in the recovery so far is flattening out?
I would put it a little bit differently and say that the bond market's really been pushed a lot by the Fed. So the Fed is still buying a tremendous volume of bonds. It's keeping the Fed funds rate pegged at essentially zero. And listening to Jay Powell over the last few weeks, it seems that's the intent for many, many years. The Fed has also shifted its inflation targeting. So the Fed is sending very easy signals to the bond market, and the equity market's latched onto that too. So the equity market has said green light for risk. The bond market said essentially the Fed is buying all the bonds, so therefore yields are low. We think that balance starts to tip, and Treasury supply is very heavy, and that pushes yields up in time.
Right, although it's not like you're saying, we're going to hit 1% and keep going. So this is different than those kinds of calls that think there's major inflation coming, a major bond market sell-off. Gina, let me come back to you and kind of what we're talking about for the recovery, because it makes a big difference to the stocks you'd want to own. If you're right that we're going to give way to a slower and more drawn-out phase, would that make growth stocks more attractive because investors are willing to pay up for where they can find that rate of growth?
Actually, I think it goes the other way, Kelly. I think that it actually makes some of these value stocks finally attractive. And we've actually seen value trying to resurge. We've seen probably 2 or 3 head fakes in this pandemic where we've seen value stocks or even just sort of cyclical names try to make a comeback. Much of that, I think, still latches on to whether or not just we have a recovery, but we need additional stimulus at this point. While the Fed has certainly made their stand, they said, we're here for you, we're going to buy everything we can. That is clear. But what we really need to see a real surge in cyclical stocks and in some of these value names is continued stimulus. Without that stimulus, we probably actually could threaten the recovery. So instead of having a slow recovery, we end up double dipping. And that would be very negative.
But explain to me, because I don't fully follow why a slower growth kind of trajectory from here would make the value stocks more attractive.
Because the growth names are already priced for very, very aggressive growth at this point. Growth names are well priced. Value stocks, on the other hand, are a good price right now. And so if you think that the growth is going to disappoint, well, you're paying too much for most of those names. And you're going to have to think about how to rotate out of that into sort of some cheaper names.
Interesting. All right. So finally then, Michael, before we go, what would your advice be to investors maybe in the stock market, of all different kinds of stripes. But they say, well, wait a minute. OK, you're talking about bond yields moving back up. But is this the kind of event I need to be worried about?
Well, frankly, Kelly, from our perspective, we think yields go up a little bit, but nothing terrible. So whether it's 1% of the 10-year late this year, early next year, this is really nothing to be too concerned about. It was 190 and change when the year began, so it's still a pretty low yield, to be sure. And for most of your viewers, I would say if yields go up even somewhat, you're going to wind up with negative total returns. So I would counsel most viewers to avoid buying treasuries that are longer than 5 years. If they really want to find a place to hide out during the stock market turmoil, stay pretty short in the bond market.
All right. Very well said. Thank you both. Appreciate it today. Michael Schumacher and Gina Sanchez speaking about all of these markets.